Boris Schlossberg. We'll be taking a look at a very in macro land, with the most dominant force being the fact that we have four, not one, not two, not three, but four central bank decisions on our plate today, this week, starting with obviously the most important one on Wednesday with the Fed. The market is anticipating 75 basis points, which at this point would be a relief given the fact that we had this enormously sharp CPI number that came out last week that shocked the market. And as a matter of fact, you can make the argument that the market continues to be shocked by this number, as we've just done nothing but slide down in all the equity indices as a result of that CPI number, on fears that the Fed is going to have to become even more tougher on monetary policy. There is a whisper numbers going on right now that the Fed might raise fully 100 basis points as kind of shock therapy for the market. If that were the case, it would certainly be a very, very tough blow to equity longs. Even though market may be mentally prepared for it, the actual reality of a 100 basis point rate hike, which would really, really dampen credit markets, and more importantly, put us on a path well into the 4% rate very, very quickly, would be a very, very difficult and dangerous macro move. Not the least of which, first of all, it would certainly dampen consumer sentiment. It would certainly dampen credit. But more importantly, and perhaps most dangerously of all, by raising rates so far, so quickly, the Fed is really wreaking havoc with the budget of the United States of America. As you are well aware, the U.S. has a massive budget deficit, which it needs to finance. And one of the most important tailwinds for fiscal policy over the last decade has been the fact that you could essentially increase budget without really increasing the cost to the Treasury, because interest rates were so low. Debt service, which is really the only thing that matters, because when you think about federal budgets, especially big sovereign nation budgets like US or Europe, nobody really cares about the underlying amount of money owed. That money just simply gets rolled. What's of most pressing interest and most pressing concern to anybody who is managing the fiscal budget is debt service. When we were at zero interest rate policy, debt service was minuscule. Even at 2% rates, debt service was doable. But if we go to 4% rate, debt service could comprise, I'm not quite sure what the actual numbers are, but it could be as much as literally 20 to 25% of the overall outlays. In other words, fully a quarter of every federal expenditure done on the budget could be debt service. That's where it becomes extraordinarily dangerous for monetary policy to effectively destroy the economy. And I think that's what the Fed is very much concerned with. So in my opinion, it would be extraordinarily surprising if they overweight the near-term inflationary pressures over the much more longer-term concerns. They're going to go too far, too fast, and that's going to create very, very difficult conditions for fiscal authorities. So the Fed, of course, is going to set the scene for everything.